Hey everyone. Due to the major events of the past couple of days, I thought I'd do another video because things have changed completely and uh, we have to go back in more of a bullish mindset, and I'll explain why. So my initial thesis, which I outlined before the CPI print, is that we would get a core CPI print and it would cause equities to move up and do something like this. This was the overlap with the 2018 correction, which was the same size as this one. And it looked like I think we were around here, June, something like June 11th. And it tried to move higher but failed and went down a bit due to the war. But now this is back on the table and I will explain why here. So there are a couple of things we need to talk about. First is oil prices. The Iran war was only relevant from the perspective of oil prices, which, due to the move up, caused a reemergence of inflation expectations or an increase in inflation expectations, which, as of now, has proved to be completely unfounded because oil had, from what I found, the second worst single day move in history. This was like a 13% swing from top to bottom, 15%, even worse. Uh, and I think this was the second worst day since this one from COVID when it went into negative territory. So second worst day in history for oil, single day performance, and this proved to be fake. So now expectation is that oil will go back down to the lows if the peace sticks, and inflation expectations also have to go down. Additionally, due to inflation actually spiking up for the previous print, the one we had this month, uh, we might actually get a benign print for next month as well. And yields have gone down a bit here. I still think this continues to go down, but the real turning point will be next month CPI print. We've already seen some Fed governors, Waller and some other one, I don't remember the name. We're talking about maybe seeing a potential cut in July already. Jay Powell didn't confirm that in his statement for Congress, but it's still like a dovish flip from the Fed's part. And up until now, the market did not like any of Trump's attacks on Jay Powell. Like he keeps demanding that he cut rates and cut rates big, not just small, like 2 points or something like that. And while the market's reaction, if something like this were to happen, is going to be spiking the long-term yields, it doesn't really matter for what Trump wants and needs. It will actually help him tremendously or help the US government tremendously if the Fed cuts. And that is because of this. So, over the past couple of years, ever since the pandemic, when yields, or not since the pandemic, since we had the inflation scare of 2022 when the Fed started hiking. But since 2022 until now, the US government has shifted towards issuing a lot more bills than notes and bonds. And you can see this is a forecast for the future, and 1 month back as well. But this is what it looked like for all ever since 2022, basically. One of the ways the previous administration and Yellen combated the spike in long-term yields was to issue more bills. So bills, there are three types of government bonds. They're all bonds, but they have different names. Bills is 1 month to 1 year. So any issuance, let me go here. So any of this, 1 month, 2 months, 3 months, 6 months, 1 year. So all of this is bills. Then we have notes, which is 2 year, 3 year, 5 year, 7 year, and 10 year. So all of this is bills. Notes, sorry. And we have bonds, which are the 20 year and the 30 year. And a way in which they kept the long-term bond yields low and notes was to issue more bills. And that is a problem because these mature in 1 year and the government has to pay a lot of interest on them. And this is what actually has blown up debt servicing payment for the US government. The fact that they have only, or not only, a lot of bills in their balance sheet, they have to pay interest on all of those. And these are actually uh, quite affected by what the Fed funds are. So if the two if the Fed funds rates goes below that level, and this is the level, basically they're all at the FFR. This one is a bit higher for some reason, but essentially they are at the FFR. The FFR is 4.325, 0.4325. So it's this is the FFR, and as you can see, in general, they remained around this level. Both the 1 year, it was here. Like if I put it on all of them, we can see that that is exactly where they sit. Like they move slightly around it, but not significant in a significant way. I have no idea why the 2 month went a bit higher, but it's sort of irrelevant anyway. It's not a sustained move. So 4.325. So this being said, if the Fed cuts, all of this will go lower. So if the Fed cuts by 2%, this will all of this will go 2% lower, and it will help the US government servicing tremendously to do that. And if that were to happen, uh, the deficit would decrease. So it's kind of a who blinks first situation in which if the Fed doesn't cut, the deficit remains high because US debt servicing costs are very high. If but the government wants to reduce the deficit, but they want to do it by outgrowing the debt. But on the other hand, they need lower servicing costs and so on. So who blinks first? So while JPOW's reluctance to cut is appreciated and it will help keep inflation lower over the long run, we are in a very precarious place in which cutting would actually help reduce the deficit because all of these bills would give less interest, at least moving forward. So that's kind of the situation where we are. And on the other hand, there are cracks in the jobs market appearing. Like it hasn't broken yet, but it's not looking good. First of all, let's look at the unemployment rate, which from a percentage perspective, and this is rounded, like it could be 4.16 or 4.24. It will still like be 4.2 here because it's only one digit. But it's theoretically flat for the past 3 months. But when we look at the actual numbers, we see a slight increase. Like it's been on an uptrend since January. And since January, we went from 6.8 million to 7.2 million unemployed people in the US. So it has been increasing even though the rate is flat at 4.2. Secondly, this is job openings over unemployment level. So the number of job openings divided by the number of unemployed people. And generally speaking, how you read this is 1 equals there is one job opening for each unemployed person. And at the peak of the post-COVID recovery, there were 2 job openings for each unemployed person. So this was a very tight jobs market. Like every company was looking for someone. There were 2 job openings for each person that didn't have a job, and that's a very tight jobs market. But when this goes below 1, it's a very negative sign. So in general, in the past, it stayed below 1 overall, but considering where we're coming from, like we don't want to see this going below 1, either by the number of unemployed people increasing or by the number of jobs opening decreasing, and we could see actually both happening. Then we have the Kansas City Labor Market Condition Index, which has been decreasing ever since that peak in 2022 and has been accelerating down lately. It's starting to have the look that we see here or the look that we see here, and it's not that encouraging as well. Like an acceleration at this level, at this point, is not really that good. And unemployment and the employment to population ratio, which is sort of like a reverse employment rating. This unemployment rating counts the number of people as a percentage who don't have a job. This counts the number of people out of the entire population who have a job. And this doesn't look that good as well. Like we see it look more like this or like this or like this. It looks more like a top than something healthy. And same as the unemployment level, even though the unemployment rate has stayed flat, this has been decreasing over the past couple of months uh, and showing decay. So the job market is not that strong. So the combination of some fat people flipping, which I don't think they are flipping for nothing. They're seeing some cracks and they don't like it. Um, Inflation not really being that worrisome, and I still think that we will get a benign print in next month. So we won't get that big of an inflation spike from tariffs. It will be one off anyway. I think it's time for the Fed to cut. And this will be proven in the next couple of months. We have the unemployment print next Thursday. Usually it's in the last week of the month, but because we have a Monday here, it's going to be in this week. And it's usually on a Friday, so next week is going to be on a Thursday here because July 4th. So uh, we may see a spike to 4.3 or even a bit higher, not officially above 4.3, but 4.34 or something like that might be happening. And the combination of weaker unemployment or no weaker employment and inflation not coming back very strongly, which we will see on the 15th on the next CPI print, I think can be supportive of equities, at least initially. So looking at this correlation, we have until end of month, potentially a correction afterwards, and then another leg higher. We'll see if we get to 6,300 here. If this breakout sticks, and I actually have no idea. It's a very tough spot to read. I don't claim to have an edge on interpreting the situation. I could see it getting rejected again and going lower, or I can see it continuing here, like turning this into a support after a bit more consolidation and going higher. I have absolutely no idea, but with everything that I've said, this is actually a bullish setup, and it's more likely to me that yields continue going down and provide a backwind to equities. Oil continues going down and provides a backwind to equities, and at the same time, if yields go back down, then DXY can find the bottom as well, and this will also further weaken inflation. Like a weak dollar amplifies inflation because it costs the US imports a lot, and a weak dollar means stuff costs more. So if the dollar now turns again, I've been talking about this for a while. I still think it's going to happen. So if the dollar turns here and goes back up, then it will also be a way to fight inflation. A stronger dollar means the US pays less for the stuff that they import, and that means the inflation impact is going to be even lower. So all of this put together, and now that the Iran war is, let's say, over, uh, paints a very constructive setup for this. Like if all of these things happen, and by all of this I include a Fed starting to cut again and reducing the servicing cost of the US debt, then there is actually a potential for Trump's plan to, meaning to outgrow the deficit, to actually work. And as soon as the market starts believing in that plan, and I don't think we're very far off from that, it could provide a very strong headwind for equities, and we might actually see this play out until the end with some chop, and it's not going to be exactly like this, but final target is 6,800. So I think there is a chance that we see 6,800 by end of year. We shall see. If we get this pullback to 5,800, it's probably a good thing to buy. If we go even lower, it's even better. But things are aligning right now in Trump's favor. Whether we like the guy or not, it doesn't matter if you want to make money in stocks. So it is what it is. Just adapt to it. So that's my thesis, and that is yields will continue going lower. dollar will start going higher, inflation is going lower, unemployment is going higher. The Fed is forced to cut, and when they start cutting, they should be cutting more aggressively than initially anticipated. And if all of this happens, equities will have very, very strong backwinds and will go significantly higher from this level. So that's kind of it. Have a good one. Bye bye.